Hi again. I'm David Offenberg. I'm an associate professor of finance at Loyola Marymount University, joined as always by my colleague Josh Spisman, also an associate professor of finance.
Right.
Josh, today, oh my gosh, we're talking about impossible foods. We're talking about Beyond Meat. We're talking about GameStop. And I love this topic because it rolls so much of what we've talked about with our students this semester into one short video. Where do you want to
Yes.
start?
Well, I think I want to start with the impossible foods and beyond meat. And the reason I want to start there is I want to really make sure that we start with what is a, the difference between a public and a private company. So when we're talking about impossible versus beyond meat, they both make similar product. They're this alternative meat industry, but they are very different in terms of as a company where they currently stand. So Impossible is currently a private company, whereas Beyond is currently a public company. And the key difference in some senses, if you and I wanted to purchase some shares, some ownership shares in one of these companies, the only one we have an option to do right now is Beyond because they're public. And being a private company, Impossible announced this morning that sometime in the next 12 months, they'd like to file their IPO and go public. And their potential IPO, they're targeting right now a valuation of about $10 billion. Now that's likely going to change over this time period. But the key point here is that this is potential. We don't know, no one's trading shares of Impossible to get a valuation. We don't know exactly what it's worth. Whereas with Beyond being a public company, we can look up exactly what their stock price is. And we can look up and see that as of April 8th, they were worth roughly $8.5 billion. So we know because you and I can be trading, and let's say you think Beyond is a great company, I think it's not a great company, or vice versa, we will trade appropriately, and that's going to set the price. Impossible doesn't have that price setting and price discovery occurring. So where does that lead us? Leads us back to GameStop, our favorite place to go. So we've seen GameStop is a public company, and we know it's a public company. It's made news basically since the start of the year with the stock price. And we can see, I thought it would be kind of fun to go back and just look at their 6-month price chart, because what you can see is just how much that stock price has changed. It's, you see that big January, that short squeeze that we talked about earlier in the semester, where it spiked, and then we see, where it dropped down, but it's gone back up. And this is basically showing that the public markets, whatever you think, whether you think it's right or wrong, the public markets are indicating that GameStop is worth more today than it was, let's say, last October, clearly from the stock price. And so GameStop is now going to take advantage of this because their valuation is higher. They can sell shares and make more money. And that's exactly what we saw them announce this week. On Monday, on this past Monday. So they're going to raise up to $1 billion. They're going to issue 3.5 million shares to do this, which leads us to dilution of 5%. And now I can get to your favorite chart, which is what actually happened. How did the market react? And so here is looking at intraday price changes for GameStop going back to March 31st. The markets were closed on Good Friday, and then we can see what happened on basically Monday when they announced this big announcement that they're going to issue shares.
And I love this graph. I love this graph so much because it shows the confusion in the market. Because when they announced that dilution, I mean, there should be at least four things that happen, some of which make the stock price want to go up, some of which make the stock price want to go down. So the dilution, the 5% dilution, it should make the stock price go down by 5%. And in fact, the stock price went down by about 15%. So there was that one effect. But also, if you think about it from a capital structure perspective, and we've been talking with our students about capital structure this semester, how much debt and how much equity are on the balance sheet. Right. In this announcement, GameStop said, we're going to try to get rid of all of our debt. And normally, having debt is a good thing because it provides an interest tax shield. It reduces the taxes the company has to pay. But that's only if you're making a profit, and GameStop is not. They're unprofitable. So that means that they get no value out of an interest tax shield. They get no value out of debt. And so it's hard to tell if the capital structure changes are going to make the stock price go up or go down. But Modigliani and Miller, the unlevered beta says, and if you think back to stock valuation, with stock valuation, we have the cost of equity in the denominator. And when you take away the debt, the beta shrinks. And as the beta shrinks, the cost of equity shrinks. And when the cost of equity shrinks, the stock price over here should get bigger. And so that may be why we see that sudden spike, because investors said, wait a minute, the cost of equity is going down, the price should go up. And then, and then there's the signaling component. The idea that management is signaling through this offer that, you know, our stock price is too high, because managers will only sell stock if they believe the stock price is really, really high, potentially overvalued. And so then we get this, wait, maybe the stock price should come down. So there's these 4 conflicting effects. And I suspect there's another effect related to the ability to short now that there's 5% more stock in the market. But I don't even know what that looks like.
Right. Exactly. It's great. There's so much going on here.
There's so much going on, and it's such a nice bow on all that we've taught our students this semester.
That's right. It really is. Yeah. So yeah, it's great. I'm satisfied. I'm ready for the weekend.
Enjoy it, Josh.